Hello everyone, welcome to my video on risks of investing in debt securities. I have created this video to help you understand various types of risks faced by investors when they decide to invest in debt securities. Let me proceed and uh, discuss two questions first, which are in form of quiz here with multiple choice. As you can see, the question one is, a company had issued bonds for 15 years. As per the offer document, the company was supposed to pay 9% coupon to the bondholders. After 10 years, the company paid back issue price to the bondholders and decided not to pay coupon for remaining 5 years. What type of risk is this? If you look at four options here, it's not a price risk because there's no variation in the price of the bond. There's no reinvestment risk which is also arising. And there's no mention of volatility because volatility typically is linked to the market. So the answer in this case should be the call risk. The next question that we have is that an investor is not able to sell bonds at its fair market value because there are not enough buyers of the bond in the market. What kind of risk is this? And this obviously is the liquidity risk, because when you are not able to sell a bond at the right price, at the fair price, that would happen because market does not have enough depth. Now these two questions I'm sure has given all of you an insight about uh, what kind of risk bondholders can face. But in order to understand that in full detail, let me just tell you that it's very important to understand the brief description of debt securities, their key features, because that will help you to understand risk in much better way. So as you know that debt securities typically have low risk profile. Now this may not be true in all the cases. For instance, junk bonds are very risky, but most of the debt securities, or rather a good part of it, is issued by the respective governments, and that is what makes its risk little low. A source of periodic cash flow. When you buy debt instruments, you will keep on getting coupons periodically unless you are buying a zero coupon bond. Uh, so this periodic coupon helps in getting payments or receiving payments for those who are the bondholders. But variation in the market interest rate could cause a risk again here, in spite of the fact that you are getting the same coupon. Helps in portfolio diversification. We have often heard about the concept of do not put all your eggs in one basket. So when you combine debt with other asset classes, your portfolio gets diversified. There are multiple investment options within the debt securities, which means that you can buy a zero coupon bond, a floating rate bond, a fixed rate bond, a perpetual bond. You know, there are many varieties of these bonds, if I could put it, or there are many types of these bonds, if I could put it. Fixed maturity investments mostly, unless it's a perpetual bond. Okay, so only perpetual bonds are issued forever, and all other bonds have fixed maturity, and that is what makes them a different kind of instrument from equity, which is a perpetual instrument which is issued forever. Having learned this, let us move ahead and see what are the risks that we can face in debt securities. So the risk could be many, but I have listed down some of them which are most common. Interest rate risk and reinvestment risk are broadly linked to the variation in the rate of interest in the market. One very important point to note here is that the coupon paid by the company would remain broadly the same, or rather remain fixed over a period of time, or rather till the time uh, uh, the bond does not mature. Only condition here is that it should not be a floating rate bond. Okay. Because coupons are paid at the same rate by the company, uh, when the investment of the coupons is made by the bondholder, the bondholder may face reinvestment risk. Okay, and there could also be a interest rate risk when yield in the market fluctuates, because of which the price of the bond may go up or down. So that's about the interest rate risk and reinvestment risk. We will cover more of it as we go ahead. Call risk we just saw with an example, but there could be many other risks like inflation risk, liquidity risk, volatility risk, credit, and foreign exchange risk. So we'll look at all these risks gradually one by one and try to understand them. So let me take you to the next slide. So what is the call risk? Call risk, as we have seen in the quiz also, is the risk that a bond will be called back before its maturity. You can see one example here which very clearly will reinforce the concept that we learned through quiz. SBI exercises call option on retail bonds issued in 2011 will no longer pay 9.95% interest. So it's very clear that here the issuer, which is SBI, which is a bank in India, has issued a bond in 2011 for 15 years. It was actually supposed to mature in 2026, which is 2026, but it called back that bond in the year 2021 after 10 years, and it's no longer going to pay that interest rate, which is 9.95%. So this kind of a risk is called risk, because investors who would have subscribed to such bonds would have thought that they will keep on getting the same interest till the maturity, but actually they have not got that interest, because of which the call risk has got created. Okay, so let us move to the next concept, which is about credit risk. And this is a very common risk when it comes to the bonds, because credit risk is about ability to pay back, or ability to meet the commitments which may be made by an issuer when the bonds are issued. So if an issuer is not able to pay either the principal or the interest, which is the coupon, then there could be a credit risk. Even a delayed payment could result into credit risk. So as you can see here, there is a news which again says government-backed IFCI slips to high yield grade, raises investor concern. And this IFCI, which is a government-backed institution, could not pay on time. So there was a delay in the payment, and that could also be part of the credit risk. So credit risk does exist in all the bonds, including the bonds issued by the government. Okay, but the government bonds tends to have almost zero or very low credit risk, but government-backed institutions may still have credit risk. So we need to understand that very clearly before we make investments into such securities. The third type of risk is the interest rate risk, which will primarily arise because of fluctuation in the market interest rate. As I said earlier, the coupon issued by the company will remain fixed if it is a fixed coupon bond, but the market yield will keep on changing. Interest rates are very they're dynamic variables. So you would see that interest rates are cyclical. They move in cycles. Okay, they go up, then come down, then again move up. Okay, so interest rate risk would arise when interest rates changes in any economy, and that has an impact on the price of the bond. And we know that there's an inverse relationship between bond price and the yield. So interest rate risk is basically also the risk which will have an impact on the price of the bond. Reinvestment risk, which is the next type of risk, is the risk that arises because an bondholder is not able to invest the coupon at the same rate that he's getting the coupon. So if you're getting coupon at 8% and you can reinvest that coupon at 7% once you have received it from the issuer, then you will face reinvestment risk. Reinvestment risk and interest rate risk, as I said, have kind of linkages also. When interest rate goes up, bonds price falls down, but reinvestment income goes up. Having said this, let me also tell you about the volatility risk. Bonds typically are not very volatile instruments, not like equity, not like commodities, but they do have volatility. And the volatility arises because of the fact that there could be many news and events which impact the bond prices much beyond the fundamentals. Okay, like when central banks and leading central banks like Federal Reserve or European Central Bank or Bank of Japan, or even in India the RBI, when it decides to change the interest rate or indicates that there could be volatility before such kind of an event happening. Geopolitical crisis can also cause a lot of volatility to the interest rates, like Russia-Ukraine crisis, where there is an uncertainty and you have the macroeconomic dynamics changing significantly because of higher crude prices or any other factor. Then there could be an impact on the volatility of the bonds, and bonds may become more volatile. News or events like union budget, that's a very India specific example, because when budgets are announced, when union budget is tabled or published, okay, then government kind of lists down its plan for borrowing, and the more the government borrows, the more is going to be the issuance of the debt instrument in the market, and that could also impact what is called as the volatility of the bonds. Having said that, let us move to the next type of risk, which is called as the liquidity risk. Now, liquidity as a concept means that any person who holds an asset should be able to dispose of that asset as and when the need arises. Some of the assets are not very liquid, like real estate, like gold, commodities and all that. But bonds are liquid, but they tend to suffer from liquidity risk also if they are not traded frequently. So lack of trading volumes typically would cause liquidity risk, and that will get demonstrated in a very huge bid-ask spread, which is also there. And in many countries where financial markets are not developed significantly, there are more and more OTC trades. Okay, in such cases, what will happen is that you will find the liquidity problem with the bonds because they are not traded on organized markets. Inflation tends to reduce the purchasing power, and it also reduces the return of the fixed income instruments. So if you are getting 8% return on a coupon and inflation is 9%, then effectively you are not getting any return, or rather you are getting a negative return. So real return becomes negative when interest rates or coupon is less than the rate of inflation. So inflation risk means the risk that your real returns from an investment in a bond will turn negative. This does not mean that you are not paid coupon. You will receive coupon, but the effective value of that coupon would be less than what you would have thought you will get, because inflation has eaten away its buying power. Okay. And finally, we come to foreign exchange risk, which is also a critical risk. As markets become globalized, companies raise capital in form of debt in various countries, and because of which what happens is that we have foreign exchange risk. If a bond holder in country X has purchased bond issued in country Y, so the foreign exchange risk will primarily arise because of appreciation or depreciation of the currency, because there are two currencies involved. So if an Indian investor has purchased US bonds and rupee depreciates, then he will get lesser return. Similarly, if an Indian investor has purchased US bonds and rupee appreciates, then he would get higher returns. Okay, so appreciation or depreciation of currency will make an impact on the what you call as the effective return as far as the foreign exchange risk is concerned. So foreign exchange risk has to be looked at in terms of the dynamics of the interest rate, and then a decision has to be taken. Having said that, I have covered all the risks which are relevant to debt instruments broadly, and I will just request you to share your feedback about this particular video. Like my channel, that will really encourage me to publish more videos in the days to come. Thank you all, and hope to meet you in the next video soon.